So good to have you join us again. It's a business breakfast on iBrandTV. Let's get talking now on the second conversation. Amid macroeconomic headwinds confronting the global economy, the United States has been projected to fall into a recession in the fourth quarter of this year due to the crisis in the banking sector. According to its media outlook, the British banking agent asset manager, HSBC Asset Management Limited, said recession warnings are flashing red for many economies, while fiscal and monetary policies are out of sync with stock and bond markets. Along with China, HSBC believes India is the main macro growth story in 2023 as the economy has recovered strongly from the COVID-19 pandemic on the back of resurgent consumer spending and services. The warning came a week after Bank of England moved to lift rate of 5%, the highest level in 15 years, as sticky inflation keeps eroding the British economy. Meanwhile, Britain's economy made a lockstep start to 2023 as inflation rates ate into household disposable income as economics see a risk of recession as higher interest rates keep up the pain even as inflation eases. Now, startup founder of Wealth Hackers, Benga Onifade, joins me now live virtually from the United Kingdom to give us more insight into this development. Mr. Onifade, good morning. Many thanks for joining us on the program.
Good morning.
Let's get started now. I'd like to know, what is your overview, your assessment, or your opinion about the HSBC outlook on the U.S. economy?
Right. First, thanks for having me. It's quite important, really, excuse me, given that for many months the economic show's been pointing to a likely slowdown in economic growth generally world over. And if you look at, the biggest economy in the world, which is the United States, they've gone from a high last year of inflation of about 9%, but now it's actually been halved. But also during the process, I think businesses have actually been reacting to that. We're looking at the biggest, corporations like Google, Amazon, Netflix, etc., and they have been cutting costs gradually. They've been reducing staff numbers in the thousands. And I think, if we look at, for example, this year, we're talking about 151,000 tech layoffs. So. This is actually pointing to a slowdown in the economy. And of course, if you look at the key definition of the recession, which is a negative contractual growth over 2 quarters. So that is one of the things, or the reasons, the main factors that is making the HSBC point out that, we probably, will see a recession. But I think one of the key things we should note, though, also is, number 2, while inflation is gradually coming down, it's not coming down as fast. And at the same time, one of the key policies of President Biden in America is that he's focused on 2 things: inflation reduction, but at the same time he's been focused on growth. So inflation has actually been sticky and prices remain stubbornly high, unfortunately.
Okay, good one there. But I'd like to know, how has the financial and stock market reacted to this news?
So one of the key things that people fail to realize, or not many people realize, that the stock market is not the economy. So most of the time, you would have had a recession even before the people know it, because the stock market tends to lead while the economy lags. So the stock market's actually had its downtime, and I think we've seen the worst of the market from about I think it started happening from about March, February last year, contributed with the contribution from the Russian-Ukraine war. We had a very big dip. It actually, became a slowing market, really. We had a negative, so they call it a bear market, when the market reduces by 20% in any one session. So we had a bear, but the market's actually been able to proceed back to that same level right now. So right now, any other thing you get, it's in the stock market, they tend to call it a distraction or a noise, because the stock market's actually had its recession, but then before you get that in the real market, it tends to lag. It might take about 6 to 18 months. So as far as the stock market's concerned, right now, if you actually look at the tailing. We've had it from the up of 2020. It's actually dipped heavily in 2022, with providing mostly negative returns for all investors and traders alongside. But right now, the market's eventually picking up. But like I said again, it leads while the economy lags, and the economy would not realize or not pick it up until about 6 months. So the down markets in the market would not eventually reflect in the economy until about 6 months. But right now, these are all being factored into the market, and it doesn't respond or react to it anymore.
Okay, good one now. Despite the hawkish tone adopted by central bankers and the apparent stickiness of inflation, particularly at the core level, what are your expectations from the U.S. Federal Reserve regarding the interest rate movement?
Oh, sure. Okay. So one of the things is, I mean, for the sake of people listening, the Federal Reserve is more or less the Central Bank of America.
Yeah.
You know, we have Powell, Jay Powell. So one thing is he's been raising rates, and I think one of the key blames he had, many people said, you know, he wasn't raising it fast enough. You know, people refer to one of the most famous, you know, the Fed chairman, Volcker. You know, they talk about Volcanomics. He raised it to the point of tipping America into recession, killed inflation as fast as he could, just to be able to get America back running again. Jay Powell, I think the last couple of years, he was denying it, and he said this is transitory, but eventually it hits us in the face. And of course, he said every time, you know, they have the Federal Open Meeting Committee meeting, FOMC, he keeps saying that he will get this job done. He will keep raising rates until, but the last session at the meeting, because the markets, I mean, inflation's actually been halved, you know, and people thought he's been doing a good job. And one of, you know, you've got to look at the body language, and one of the things he did was he maintained the rate. He didn't hike it, he didn't reduce it. Yeah. So the market's actually reacting to that, and it's showing that inflation is coming down. Whatever he's doing is working. So he might say this, but he's not guaranteeing that there wouldn't be no more hikes. But at the same time, right now, it looks like things are gradually working. Even if we're going to get a recession at all, it might just be a very slow one, a very little one.
Okay, good. I'd like to know your assessment of the U.S. financial sector, going by the collapse of Signature Bank, Silicon Valley Bank, and all the banks in the U.S. What would you say is the state of the U.S. financial sector?
Oh, that's a brilliant one, actually. So, as you know, if you think about it, likewise, as in 2008, you know, we had bank collapses, and this is really what happens when there's inflation hikes so much. You know, you get a bank run, everyone is so scared, and of course, taking out the deposit as much as they can. So I think one of the key things that America tried to do is, you know, and in fact, if people want to look at the scale, you know, SVB, which is the Signature Bank, for example, that alone is actually worth bigger than the whole entire 2008 crisis. So this has actually been way more. You cannot, or personally, I cannot guarantee there wouldn't be much, you know, there won't be more bank failures, because all banks right now, they are literally trading at the, you know, kind of the 10, 20-year lows right now. So there's that fear of, you know, thinking, okay, this might still happen. But there's actually been a few prompts again by, is it Janet Yellen, one of the Fed executives, and she said, you know, we will protect some of these banks. But again, because with the fact that, you know, prices are still coming down, but there's still the fear. So I think with prices coming down, there's still the odd, you know, so it's, you call it a chicken and egg approach, really, and the growth being forecasted as well for American markets. You know, the president's not allowing or guaranteeing people's deposits, so it's kind of bringing extra confidence in the banks as well. But people are still scared, because you can't trust, you can tell me you're going to protect my bank, or you're going to protect me, but at the same time, if I'm seeing failings around me, people are still a bit jittery. So as a result of that, it's very difficult to predict. So right now, you cannot predict more bank failures, or, you know, there wouldn't be any more bank failures. But right now, things seem to have stabilized, and all of a sudden, they just need to start picking up. And eventually, we know the banks tend to quickly recover anyway. They just tend to be bad investments overall. But again, it's all about, you know, and of course, based on gradual projection anyway, with America leading, there is the forecast that, okay, the economy might dip a little bit, but things will pick up gradually, I think, to about 0.9 rise at the first quarter of 2024.